So this is pain before gain. But this 3 or 2 months of pain that we have here could be bad. It could be pretty severe because, I mean, look at Snap. It's down 40% today. That's a wipeout. And that stock was already down something like 70% from its highs before it dropped 40% today. So the damage is pretty severe, but I think there's some fabulous long-term buying opportunities in these in the market at these current levels. So
what's up, HGI investors, and welcome back to Hypergrowth Investing. I'm Aaron Davis, and as always, pleased to be joined by investment analyst Luke Lango. Luke, what's going on today?
how you doing, Aaron? It's good to see you. Good to be talking. Rough day in the markets. We'll get to it in a little bit, but there is a lot to talk about.
Definitely. We have a ton of topics that we're going to get to in just a few moments. But quick, if you're listening to this for the first time, Hypergrowth Investing is the weekly podcast that picks the brain of investment analyst Luke Lango. Each week, we take an in-depth look at emerging tech and investment innovations, electric vehicles, cryptocurrencies, the metaverse, and more. Nothing is off limits. If you're joining us for the first time, we go up every Wednesday on YouTube, Spotify, Apple, Google, wherever you choose to listen to your favorite podcast. So make sure to like and subscribe to get Hypergrowth Investing as soon as it goes up. Again, I'm Aaron Davis, educator and lifelong learner, and your proxy into the mind that is the Luke Lango. Luke, let's dive right in. Some breaking news last night from Snap, basically as a reaction to how the economy has been doing for the last few weeks. It's announced that it's going to miss its targets, and it seems that social media and FANG stocks and tech, everything seems to be down right now. Is Snap right now that canary in the coal mine that's giving us warning for what the future is to come?
Yes. In short, yes. Snap's warning shot last night was a shot heard around the world, and it is maybe the scariest thing that I've heard in a very, very long time, maybe since the emergence of COVID, because what's happening here is Snap is... A lot of people can make fun of Snap as this kids-only application, or, you know, they can't monetize, la-di-do. Well, that's all hocus pocus. Snap is a fantastic company led by very genius people, very bold people, very visionary people. The app has a very sticky and highly engaged user base. Yes, that user base skews young, but as that young user base has grown up a little bit, you know, you've turned high school engaged users into working adult engaged users. So Snap is a very strong social media platform, very strong application. And the ad business is one of the fastest growing digital ad businesses in the world today, a very sizable digital ad business in the world today. And based on a lot of reports and research that we've done, that ad platform has one of the highest ROIs for consumer packaged goods and consumer brands out there in the marketplace today. So Snap is a very strong digital advertising company. And that very strong digital advertising company is now going through a sudden, rapid, and violent deceleration in their growth because of deteriorating macroeconomic conditions. Now, that by itself is spooky. 4 weeks ago, Snap said they're going to grow revenues at 20 to 25% year over year in Q2. Now, just 4 weeks later, they're saying they're not going to grow at 20%. That's a rapid, deceleration. And that's a 4 week stretch where we're losing 5, 6, 7 points of growth. Pretty wild. That by itself is scary. But throw that on top of last week we heard from Walmart, consumer slowing. Target, consumer slowing. Home Depot, consumer slowing. Lowe's, consumer slowing. TJ Maxx, consumer slowing. We heard from Abercrombie & Fitch today, consumer slowing. So we have this huge picture of a consumer slowdown going on right now. Then at the same time, you have Uber, hiring freeze, cutting cost. Robinhood, hiring freeze, cutting cost. You have all of these tech companies, Meta, doing the same thing. And now Snap is doing it as well. In addition to announcing they're going to miss Q2 targets, they said, hey, we're going to slow the pace of hiring. They've hired about 2,000 people over the last 12 months. This year, they're going to only hire about 500. So you're talking about a 75% reduction in the pace of hiring. They're going to tighten their belts. Evan Spiegel is asking all of his managers to, where you can, cut costs. So they're in ultra defense mode too. So you start connecting the dots, start painting this picture. Whoa. The consumer is rapidly slowing. Everybody's saying, all these big retail guys are saying, hey, January, February, consumer was strong. March, pretty strong. Towards the end of March, they started to slow, and it's been real slow ever since. Every major retailer has said the exact same thing. So the consumer is slowing. Now, Snap is saying, hey, because the consumer is slowing, brands that sell to consumers aren't advertising as much. So ad spending is slowing. And that's causing the advertising platform like Snap to itself cut its own cost. Snap uses things like Zoom, DocuSign, all of those things. So now spending on those platforms is going to get hit as well. So what you have to understand is that Snap's announcement doesn't just exist in isolation. It has upstream and downstream effects. And the upstream and downstream effects imply that this whole river is starting to slow dramatically. Now throw in the macroeconomic data. Today, U.S. PMIs for services and manufacturing both dropped pretty significantly month over month. Home sales, new home sales dropped 16% month over month in April. Huge drop off, missed expectations by a mile. So the macroeconomic data is also starting to weaken pretty dramatically. Again, put that into this cocktail we got going on here, and it's not pretty. It's really scary. It looks like the economy is rapidly slowing. Snap is the canary in the coal mine. You're seeing Facebook get hit hard. You're seeing Alphabet get hit hard. You're seeing Amazon get hit hard. You're seeing Pinterest, the Trade Desk, everything across the digital ecosystem, Roku, Netflix, they're all getting hit hard. This is the beginning of Wall Street starting to understand that this economic slowdown is very real. Does that mean stocks go meaningfully lower here? Maybe, maybe not. It all is going to depend on the Fed and the course of inflation. Because at any point, Powell can turn on the dovish jets and kickstart this economy and kickstart the markets, and advertisers will start spending again, consumers will start spending again, enterprise software spending is going to go up. At any point, Powell can kick those jets on. So that's the Fed put we're talking about here. But Powell's not going to kick those jets on. He's made it abundantly clear. He's not going to kick those jets on until inflation meaningfully decelerates. And we've only got 1 month in the bag of inflation decelerating. So we're going to want to see 2, 3, maybe 4 months of that deceleration before the Fed starts to actually pivot dovish, which basically means, from a macro perspective, what I think happens here is you get a pretty marked slowdown in economic activity over the next 2 to 3 months. That slowdown lessens economic demand by enough to accelerate what is already a slowing trend in inflation. So that by July or August, inflation is much, much lower than where it is today. That sets the stage for the Fed to take a dovish pivot by the third quarter of 2022, at which point you're going to see the U-turn materialize in both the economy and stocks. So this is pain before gain, but this 3 or 2 months of pain that we have here could be bad. It could be pretty severe because, I mean, look at Snap. It's down 40% today. That's a wipeout. And that stock was already down something like 70% from its highs before it dropped 40% today. So the damage is pretty severe, but I think there's some fabulous long-term buying opportunities in these in the market at these current levels. So we're staying constructive, we're staying bullish, but we're fully prepared for what could be a pretty messy June, maybe in July too.
So, and that kind of brings me to my next question. You are traditionally pretty bullish on a lot of the things that you research because you're doing that research and you understand what's going on. How does this fear that you're talking about, how is that going? How should investors be taking that fear and applying it to what they're seeing with inflation, with the market, with the Fed, with
Right,
all of
right,
it?
right. Well, what you're understand is during bull markets, everyone's a long-term investor, and during bear markets, everyone's a short-term investor. Like when you're in a bull market and the rising tide's lifting all boats, everyone's like 3, 4, 5 years down the road. They think with a long-term time horizon. But in bear markets, no one gives two flying blanks about the long-term horizon. It's all about that short term because a lot can happen in short times, in short periods during bear markets. Snap can drop 40% in a day in a bear market. That's what happens in bear markets. So everybody's mindset becomes immediately shortened during bear markets. And that's why you have to acknowledge the short-term kind of trading going on in the US stock market today, because that's where the market's mindset is. It's not about, these companies are going to survive through the recession, they're going to thrive on the other side, and they're going to be long-term winners. That's 100% true. Snap, if you have a 3 to 5 year time horizon, Snap stock is 100% fabulous generational buying opportunity at current levels. I mean, truly remarkable. Just let me share a chart with you real quick.
Sure.
I got this new screen sharing tool, everybody. So I'm pretty excited about that. Let me go to my Snap chart.
And for our audio listeners, we're just bringing up a chart of Snap right now.
Oh yeah, sorry, I forgot that there's audio on here.
There is audio. We do have our audio only listeners, which is great. We love them too.
A chart of Snap on Y charts. I'm going to pull up the fundamental chart here, and we're going to look at the valuation on it. We're going to look at the price to sales ratio on Snap at the current moment. And we're going to pull up that max chart. So here we go. We can see that price to sales on Snap right now is about 4.9 times trailing sales, right?
Okay.
So at 4.9 times trailing sales, that is below where the valuation was at the trough of the COVID-19 pandemic collapse. It got to about 8 times trailing sales on March 20th, 2020. It is below where this stock was in late 2018 when this was a $5 stock. I remember it back then. That was trading around 7 times, a little bit under 6.7 times trailing sales. So now we're at 4.8. So we are meaningfully lower than the lowest valuation this stock has ever traded at. So for long-term investors, Snap is a fantastic buy here. I mean, what they're doing with augmented reality software, they're not even really trying to be a social media company anymore. What they're trying to do is build AR software kits to enable AR commerce, which is, let me stop sharing my screen here. I think we got the picture of the valuation. So Snap is really doing some really cool and innovative things with augmented reality. I don't know if you guys have been on the Snapchat app recently, but where they have their AR try-on filters.
Okay.
They're very hidden in the app. They're not doing a great job of advertising them, but if you go and find them in the application, they're very cool. You can try on watches with their lenses. You can try on clothes. You can try on glasses. Prada and Gucci, you can try on their glasses through the app. So it's a really cool feature. It's really advanced, and that is the future of shopping. Snapchat is opening up that dev kit so that other retailers can now use those AR lenses on their own websites. Snap is trying to become a B2B solutions provider for augmented reality commerce, and we think that is a huge growth opportunity. So long term, this stock and this company, fantastic. Fantastic buy at current levels. But you have to understand that in bear markets, people don't really care about that. In bear markets, they care about, okay, they're getting a huge digital advertising slowdown right now. Snap's at the epicenter of it. Estimates need to come down. The stock's going to go down. So you're going to get that near-term flush out. That's going to happen in Pinterest. That's going to happen in the Trade Desk. That's going to happen in Facebook. That's going to happen in Google. It's going to happen in anything that has any digital advertising exposure. Is because of this slowdown, estimates have to come lower, so the stock's going to go lower. What we have to do as long-term investors is go through the wreckage and find the opportunities that are trading at generationally low valuations that have fantastic long-term growth prospects, whether that be through augmented reality shopping or digital advertising or some combination of the two, and buying the dips in those and holding through the noise. That's what we as long-term investors have to do today to succeed in these markets.
So based on what you're saying, it seems like Snap is checking all those boxes right now.
I think Snap is a fantastic buy. Fantastic buy at these levels. Like I said, all-time low valuation, sub 5x trailing sales for what will probably be a 20 to 30% long-term revenue compounder with an 80% potential to be an 80% gross margin business that has potential for 40% plus operating margins. Yeah, this is a fantastic stock to buy and own here, but only if you're willing to own it for the next 3, 4, 5 years. If you're looking to buy and sell this thing in 3 months, 6 months, folks, it could get ugly over that time frame, simply because the economy is rapidly slowing. Advertising gets hit during slowdowns. 2001, ad spend dropped 5%. 2009, ad spend dropped 10%. 2020, ad spend dropped 4%. So recessions tend to knock down ad spending 5 to 10%. So we're talking, a pretty sizable slowdown, and that is Snap's business today. So Snap stock, short term, definitely has some major headwinds. Long term, the value creation potential from a 5x trailing sales multiple for a 20% compounder with 80% gross margin profile is fantastic. So yes, I absolutely love Snap stock at current levels, but there are other stocks in the digital advertising space that are not so great buys right now and that need a little bit more of a flush out and or simply need to be avoided because they don't have the same long-term growth prospects as a Snap. So you got to be selective, but you still have to have that long-term mindset in mind, despite the fact that the market's saying it doesn't give, doesn't care about the long-term outlook for these companies, and it's all about the short term. You got to sometimes put that to the side and stay focused on the long term.
Well, speaking of long-term, another long-term stock that we've talked about in the past, and one that you've been pretty bullish on, is Lucid. We haven't checked on them in a while. And the reason I mention this is because it seems that you've become a little concerned with their costs, despite, again, maintaining a bullish outlook. But can you discuss kind of what you're seeing with Lucid right now and why, again, still a buy, but maybe not as aggressive as you have talked about it in the past?
Yeah, so I absolutely love Lucid long term. Again, I think Lucid is the technology leader in a secular growth electric vehicle space. And as you know, I believe in tech leaders to become economic leaders. So I do believe that Lucid will become number 1, number 2, number 3 player in the entire trillion-dollar electric vehicle market at scale, and therefore is a fantastic long-term investment opportunity. The backing of the Saudi Public Investment Fund is also a massive bonus for Lucid shareholders, because not only is Big Oil just essentially pumping money into Lucid to make sure it doesn't fail, but they're also becoming one of Lucid's biggest customers. They have that 100,000 order on deck right now that Lucid is starting on today. So love Lucid long term. But yeah, let's go to the short term. They're having to raise prices on already very expensive vehicles. So you're talking about a vehicle that was already $80, $90, $100,000 plus, and now it's probably going to be $110, $120, $130,000 plus. That should have a negative impact on demand. Maybe not today, but if those prices stay elevated for the, maybe next 2 or 3 years. Not to mention production capacity hasn't been cut yet, but there's chances that it could get cut, especially if the slowdown that we're talking about, that we just talked about, continues over the next few months. So there could be some production cuts there. So there are definitely some near-term headwinds on Lucid's radar, which, again, if you're looking at Lucid stock from a 2 to 3 month perspective, the stock could struggle because of these near-term headwinds. But down here at the levels that it's currently at, with the long-term growth prospects it has, Lucid is a fantastic long-term investment opportunity. So again, it's a short-term versus a long-term. You're playing this kind of tug-of-war here. And during times like this, you have to ask yourself, what type of investor are you? Do you want to be a trader that's getting in and out of the markets and tries to make money in the stock market every single day, every single week, every single month? Are you a person that is a long-term investor that wants to buy and hold high-quality assets and let them appreciate over longer periods of time? I fall in the latter camp. I know a lot of smart people that fall in the latter camp. I also know a lot of smart people that fall in the former camp. Decide what type of investor you are and execute that strategy in these markets regardless of how the markets are acting. So long-term investors, buy and hold Lucid, stick through the noise, and let this high-quality asset appreciate over the next 3, 5, 7 years. But still very long-term bullish on Lucid, absolutely.
So do these short-term headwinds that you're talking about have an impact in the outlook in that long-term view?
No, not at all. No.
Okay.
No. I mean, what they do in mathematically speaking is they maybe push out your estimates 1 or 2 years.
Okay.
So let's say Lucid, we say they're going to deliver 1 million cars by 2027. Well, maybe there's some slowdown here, demand slowdown, production slowdown. So they don't really get to their, targets for 23, 24 until 25, 26. So then our million target gets pushed back to 28, 29. So what it does is it pushes back estimates maybe 1 or 2 years, which because, net present value, time has money, and, the discount rate there, that does dilute the net present value. So you do get some knock there, mathematically speaking, but that knock is not substantial. And if you're a long-term investor, it's not truly meaningful. So do the short-term headwinds have an impact on the long-term? I can't broadly say no, but in the specific cases where the answer is no, that's where the buying opportunities are. Now, there are some where the near-term headwinds do have an impact on the long-term growth, and that's where you don't want to be buying the dip. That's a name like Workhorse or a name like Lordstown Motors in the EV sector. Those are companies that got hit by some pretty sizable near-term headwinds. Workhorse basically lost its giant order from the USPS. And has been trying to win it back ever since, but won't win it back. That was a slam against the company's technology, basically saying the tech wasn't good at all. That has significant implications for the long-term growth trajectory of Workhorse. So if you're talking about estimates there, you had an estimate for that company 2027, 2028. That doesn't get pushed back a couple years. That may never happen. So you got to look at, are long-term estimates getting delayed or long-term estimates just evaporating? In the case where they're evaporating, like Workhorse, like Lordstown Motors, stay away. Those are not buy the dips. Those are stocks that could go to zero. Those are stocks you don't want to touch at all. But in the case where the long-term estimates are just getting delayed by 1 or 2 years, like a Lucid, and even like a Rivian, those are stocks you want to start looking to buy in this chaos because they are still fabulous long-term investments. They're just getting hit by some near-term headwinds that won't change the ultimate destination of that company or stock. They'll just change the timeline a little bit.
So we're talking, as we're on the topic of timeline when it comes to EVs, we are seeing a pretty dramatic shift, I would say, with at least at the very bare minimum, the concept of electric vehicles within our, popular culture. We've discussed, individual companies like Lucid and Neo and Workhorse in the past, but what does this broad EV adoption kind of look like in the coming years and in that sector?
Electric vehicle adoption, in my opinion, is going to accelerate because of the current geopolitical climate and macroeconomic climate. Yes, battery costs are going up because lithium, the raw input prices are going up, the raw metals. But what you have to remember, there's a couple things to keep in mind here. One, raw input prices are not a major influencer of costs for an electric vehicle. Lithium prices increased by 13% per year throughout the 2010s. And also throughout the 2010s, battery pack prices, lithium-ion battery pack prices decreased by more than 90%. So you had a 13% annual increase in the cost of lithium, yet a cumulative 90% plus decrease in the cost of lithium-ion batteries. That tells you right on its face that the raw input prices do not drive or influence the trajectory in a meaningful manner of lithium ion batteries, of the electric vehicle batteries. So what does? Well, what does influence the price of batteries is R&D in chemistry, R&D in material science, economies of scale, automated manufacturing. Those things are the drivers of lithium ion battery manufacturing costs. And that's why, despite a 13% per year increase in lithium prices, lithium ion battery prices dropped more than 90%, because we had a lot of R&D in chemistry. How do we make these things? We had a lot of R&D in material science. How do we combine these materials more cost effectively? We had a lot of economies of scale kicking in. The production lines got bigger and bigger and bigger and bigger and bigger, and we added some weight there, so we got to benefit from the economies of scale. And now we're starting to leverage automation to make these things also more cost effective to produce. So those drivers are only going to get bigger and more powerful and stronger over the next several years. So yes, raw input prices for batteries, for electric vehicles are increasing today, but one, that price increase is temporary. It's only going to happen in 2022. In 2023, raw input prices are going to go back to declining. And two, the R&D in science and chemistry and material science, the economies of scale, those factors are going to continue to drive costs lower and lower and lower and lower and lower. So I think that electric vehicle costs, clean energy costs in general, they've been on this big downtrend. They're having this anomalous spike in 22, and then they're going to go back to their, long-term downtrend. That this is not the beginning of a reversal. This is an anomalous spike back to the downtrend. So that's the first big point on electric vehicles and why I think that electric vehicle adoption is actually going to accelerate. The second point is that it's all relative. Electric vehicle costs are going up today because every cost is going up today. Okay? So when you look across the board at the electric vehicle price increases that you're seeing, well, first off, the IEA just came out with a study that said if raw input prices remain where they are today, then by the end of the year, lithium-ion battery pack prices are going to increase by 15%.
Okay.
That's a big jump.
Yeah.
But put it in context. Oil is up 50% this year. Natural gas has doubled this year. 100% gain. 50% gain. Lithium-ion batteries, 15% gain in 2022 is chump change. It's nothing.
Yep.
So yes, lithium-ion battery prices are going up. Yes, electric vehicle prices are going up. But guess what? They're going up much less than fossil fuel costs. So it's all relative. We're in an inflationary environment. Costs are going up across the board. Demand is going to shift to the things where cost is going up less intensely. And that's in electric vehicles. It's also in solar. Per recent research and per industry exec kind of commentary from the previous quarter, looks like solar costs drop about 20% year to date. Again, that's less than the 50% increase in oil. That's less than the 100% increase in natural gas. So solar prices are increasing. Absolutely. Correct. True. But they're increasing much less intensely than fossil fuel costs. So I think there's a demand shift towards solar despite the price increases because relatively speaking, they're getting cheaper than the alternatives. So that's another reason why I think electric vehicle adoption and clean energy adoption can accelerate in the midst of the current geopolitical climate because their inflation is less intense than the inflation being seen everywhere else. And that is because that is a direct byproduct of the secular cost decline drivers in those technologies. The R&D in chemistry, the R&D in materials and science, the economies of scale. These technologies have very positive learning rates. The more we make of them, the more we learn how to cost effectively produce them, the lower their costs go. Those things have great learning rates. Fossil fuels don't. Consequently, the inflationary pressures in fossil fuels are much more intense today than they are in electric vehicles, in solar, in hydrogen. And to that end, there's going to be a demand shift towards heavier usage of those items. And that's why I think EV stocks are a pretty solid bet here. Same with all clean tech stocks. I think this is kind of like a critical inflection point for adoption of those technologies. So That was a very long-winded way of answering your question, but the short of it is that I think electric vehicle adoption is going to accelerate in 23, 24, 25 at rates that the market is not expecting. And because it's going to be above expected growth, EV stocks are going to outperform in those years.
And again, even despite that 15% jump that you're talking about in lithium-ion batteries, sales of electric vehicles in the U.S. in the first quarter of 2022 rose 60% year over year, correct?
And globally, they were up 75% year over year. Yep. Yeah.
Awesome.
So again, no slowdown in this industry right now. No slowdown. And for those of us that think that you can't make an electric vehicle as cheap as a gas-powered car, it's already happening in China.
Okay.
So the IEA, again, they just released this massive EV market outlook 2022 report. And in that report, they posted the kind of range of sales prices and the median sales prices of cars, different types of cars in different countries. And in most countries, the average sales price of a gas-powered car is significantly lower than the average sales price of an electric vehicle. But in China, the average sales price of an electric car and the average sales price of a gas-powered vehicle are nearly identical. And the range is such that you got a wider range on EVs, so that there's a whole bunch of cars that are actually EVs that are actually selling below gas-powered car average sales prices. So China has achieved electric vehicle cost parity. Now, why is that? Economies of scale. China is the largest electric vehicle market in the world by a wide margin. 3.3 million electric vehicles were sold in China in 2021. That is more than the rest of the world combined. The rest of the world sold 3 million EVs in 2021. So China's EV market is bigger than the rest of the world's EV market. They have achieved significantly larger economies of scale in China than anybody has achieved anywhere else. And it's no coincidence that in China, where they have bigger economies of scale for EV production, EV costs have reached parity with gas-powered car costs. So to that end, we think that provides a very clear roadmap for the US, for Europe, for South America, for different economies across the world to, through economies of scale, achieve cost parity with gas-powered vehicles. And that's before you even factor in further R&D from, material science and chemistry, which will drive costs meaningfully lower than gas-powered vehicle cost in the long term. And we think that by 2025, globally, we'll be at cost parity. If not, EV costs will be lower than gas-powered cars. And by 2030, EVs are going to be 20, 30, 40% cheaper than gas-powered cars. That's an inevitability, and we're investing for that inevitability, not really worrying about this little anomalous spike in 2022. Long-term outlook, very favorable. We think that, again, EV stocks are going to outperform meaningfully over the next 3 years, 5 years, and 10 years.
Well, what I want to do right now is I definitely want to shift gears a little bit to some topics that we haven't discussed on the show before. But again, so starting off with biotech.
Yes.
How has the biotech market fared through this market crash?
Not well.
Okay.
Biotech's been crushed because biotech is the paragon of we don't make money today companies. Biotech, they're all companies that are developing potentially breakthrough, world-changing drugs and therapies that are going through clinical trials, and it's all about what those drugs, the monetary value those drugs could produce in the future. So how you calculate the valuation for those companies is it's 100% reliant upon future cash flows.
Okay.
And 0% reliant upon what that company is doing today. So clinical stage biotech companies, biopharmaceutical companies have been hit exceptionally hard by the recent market sell-off. And I think that's creating a pretty good buying opportunity in that sector because the technicals and fundamentals are lining up pretty positively.
Can you talk a little bit more about the technicals and fundamentals and what you look at when you're evaluating the biotech sector?
Right. So fundamentally speaking, something like 86, 87 biotech stocks are currently trading below their cash positions.
Okay.
Meaning that there are let's call it 90. There are 90 biotech stocks in the market whose current market cap is less than the amount of cash they have on the balance sheet.
Okay.
That is ridiculous. And it's an all-time high. We only got to about that number, the number of biotech stocks trading below cash value. Historically, it's peaked at 20.
Okay.
Back in like 09, it peaked at 20. In like 2020, it peaked in 20. Back in 01, it peaked at 20. So even through some deep recessions and deep market routes, the number of biotech stocks in the market trading below cash value never peaked above 20. And yet today we're at 90. We're at 4 or 5 times that. So I think that's a pretty compelling fundamental case for why biotech stocks are pretty oversold.
Okay.
There's also a pretty compelling technical case. I can share that chart with you.
Sure.
Going to my cool little new chart sharing screen. Let's see here. Let me pull up the XBI, which is a biotech ETF. Right, so here you go. So we can see this chart here. You got a good view of it, Aaron?
Yep. We can see it. Good. Yeah.
Okay, so there are 3 things we're looking at when I see XBI today. Right here, this white line. That's the COVID-19 support line.
Okay.
So we fell to about $69 and change. Let's call it 69 flat during the March 2020 sell-off in the biotech ETF. Today we're at 67 and change, so we kind of broke below it, but there is definitely some strong support right around that upper 60, mid 60 range for XBI. So you got the COVID-19 support. That's the first level of support we're looking at. The second is these oversold conditions. So as you can see on the relative strength index, the RSI, we've dropped into oversold territory here in early May. That's only happened in not just oversold. I mean, we're clocking in at, 25. So pretty substantially oversold.
Okay.
That's only happened 3 times, well, actually twice before in the history of this ETF, as you can see, going all the way back.
Yep.
Once was in early 2016 when there was a bunch of worries that the government was going to press up against biotechs and really stop them from price gouging. And that correlated with a local minimum in the stock that turned into a pretty big rally, or the ETF, it turned into a pretty big rally. Then it happened again in late 2018 when we had a very similar market crash, what we're seeing today, a Fed-driven market crash. We've talked about this before. Again, that correlated or coincided with a local bottom in the ETF that led to a pretty big rally over the next year. And so we're getting that oversold condition again down to this 25 handle. History says this should coincide with a local minimum that leads to a pretty big rally over the next few months, maybe few years. And then the third thing we're seeing in the technical pattern is if we look at this uptrend that the ETF has formed all the way back to April 09, so the depths of the great financial crisis, we have a pretty solid uptrend here. A very solid uptrend. We got the lows are connecting here. We got the highs are connecting here from, summer 2015 all the way to early 21. Got this pretty solid uptrend. And we're running into support right now, that uptrend, which clocks in right around 65, 66. Coincides really with this kind of COVID-19 support line. So right in this area, right in this 65, 66, 67, 68, 69 area, there is a lot of technical support for the biotech ETF to bottom, reverse course, and stage a pretty big rally. I think things look good for the biotech ETF. I know we talked about recession indicators. I know we talked about economic slowdown. Things are getting pretty ugly.
Yeah.
But this is one of those things where it's just fundamentally undervalued and technically oversold to a point where it might work even if the economy continues to struggle over the next few months. So biotech's a place that we're starting to get pretty constructive on at the current moment, for sure.
Awesome. Another topic that we haven't touched on before, but I want to touch on today is the concept of vertical farming.
I love vertical farming. Yeah.
We're in the midst of the largest food crisis the world has seen since the Great Depression. People are struggling to find answers. And again, if there's one industry you think could make a big role in getting us out of the problem, I think, is vertical farming.
Right.
So before we kind of get into that, can you explain a little bit of how we're in the position that we are right now when it comes to this current food shortage, and take us from there?
Yeah. So, well, before the Russia-Ukraine crisis hit, before COVID-19 hit, the world was looking at an inevitable food crisis where food production growth is lagging population growth. And that has to do with a lack of farmable land in the world. There's simply only so much land that can be farmed, that can be used to grow good crops, good food. That land is pretty maxed out today. So there's a shortage of farmable land, and we're at capacity pretty much. Climate change is taking a toll on the output and yield of those farms that are out there today. Hotter weather, more extreme weather conditions, colder weather. It's the more extreme conditions that are causing these crops to not be as plentiful as they once were. So that's a huge factor here. And then population growth. The population continues to grow and grow and grow and grow and grow. So you're getting lower food output, more people on planet. That's a recipe that means we're going to lead, kind of lead straight into a food shortage, a food crisis. That wasn't going to happen until 2050, 2060, 2070. I mean, long time down the road.
Okay.
So it wasn't a problem a lot of people were paying attention to before recent events. But recent events have sort of thrust this into the spotlight because Russia is the breadbasket of Europe. Russia supplies a lot of wheat to Europe and throughout the globe. So taking Russia offline essentially means somebody's got to feed Europe. So that's wheat that is going to feed another country, like the United States, is now going to help feed Europe. In that sense, our food shortage has become now more extreme, and this problem has become more pressing. So what was a food crisis that may emerge in 20, 30 years is now a food crisis that is here and now. And food security is becoming a very big thing in the markets today.
Okay.
And we think that companies that pioneer a solution to this food crisis are going to generate enormous economic value. Again, one of our big themes is technologies that solve problems. Vertical farming is that for the food crisis. So that's why we're pretty constructive on vertical farming at the current moment. It's a necessary and critical solution to solving what is an increasingly large food problem, not just in the US, but globally.
So how is vertical farming the answer to this problem that we're seeing right now?
Right. Great question. Yeah, I forgot to explain vertical farming. Vertical farming is the idea of using a combination of technologies to grow food inside these giant sort of greenhouses.
Okay.
Now, this can be in a giant sort of like factory like building in the middle of Kansas, where we basically take land that was not farmable, but build a giant warehouse type thing on it. And then we can now grow plants, crops, foods in this warehouse using solar panels, using solar light from the from different photonics. We can use a lot of different technologies to hydroponics to make these things grow inside to control the climate. And then what we can do is you have one layer and then you can stack another layer on top of it, because outside you can only have one layer because it's natural sunlight. And if you build a one layer of crops and you stack another layer on top of it, that first layer is not going to get sun. What these vertical farming warehouses do is you have one layer, then a bunch of artificial light and heat and climate controlled sensors, and then you build another layer and then you build another layer and another layer, so that each layer actually looks and feels like it's getting real sunlight, real good growing conditions, optimized growing conditions. So what you do is you increase your yield and your output dramatically. Again, these can happen in giant warehouses in the middle of Kansas,
Mm-hmm.
or perhaps more interestingly, they can happen in high rises in the middle of Manhattan.
Mm-hmm.
Like you can take an apartment building and in Manhattan, 100 stories up, and repurpose it to be 100 stories of crops.
Mm-hmm.
So each story is a different layer to this vertical farm. We're growing tomatoes on this one, corn on this one, wheat on this one, so on and so forth. And you can optimize each level to the growing conditions that are perfect for that particular crop. So in that sense, you also get rid of the extreme weather, right? You don't have to worry about rain. You don't have to worry about too much sun, too little sun, too wet, too dry. You control it. It's an entirely controlled environment. So you improve your yield and your output. So that's basically what vertical farming is, and how it solves the current food crisis is it allows you to grow more food with less resources and less area.
Yeah, and it sounds
You can-
like in that city scenario that you're cutting transportation costs because instead of having
Well, yeah, that's a whole other thing about it. Exactly.
Yeah.
So a big part of the food shortage today is the supply chain crisis. It's not so much that we're not growing enough food. Russia is growing a lot of food. It's just that there's a supply chain break between us and Russia. We can localize supply chains via vertical farming. We can build skyscrapers in Manhattan that have all of this food output, so that Manhattan is now not sourcing its food from, 2, 3, 4, 5, 6, 7, 12 hours away. It's sourcing it locally right there. So it definitely localizes supply chains. It reduces time from growing to buying, which also improves the quality and freshness of whatever you're buying, of the fruit or the vegetables. So there's a lot of upsides to vertical farming. It allows you to grow more consistently and reliably, reduces resources, reduces costs, localizes supply chains, improves time, improves quality, and improves freshness. So across the board, it is just superior to legacy farming, and we think that its time to shine is now.
So what inning are we in vertical farming? First, okay.
First inning, baby. This is the first inning of vertical farming.
Okay.
I mean, there are companies out there that are just starting to do this.
Okay.
Some are doing the skyscraper route. Some are doing the big, warehouse factories in Kansas route. But they're all experimenting. It's all trial and error right now. They are all growing stuff.
Okay.
Mostly it's like leafy vegetables. But this is the first inning. It's a long-term ball game. The reason we like it, we've always liked it for, 3-4 years now. But every emerging technology sort of needs that critical inflection point where the need for it becomes so large that investment into it rapidly accelerates, and development of the tech and expansion of the tech dramatically accelerates too. And we think we're at that critical inflection point with vertical farming. It's always been around. There's been experimentations. There are vertical farms up and running across the United States, but it's kind of been this like, we'll get to it when the need is there for it type thing. Well, the need is there now. And so we think that this is the critical inflection point where that technology sort of bursts onto the mainstream and those stocks start to outperform on Wall Street. So we're really excited about the vertical farming space. Absolutely.
Awesome. Shifting gears into our market check-in with the Fed. We have PC numbers coming out on Friday. We're also in a rate hike cycle right now. And, so how is this impacting inflation? What should our takeaway be with any updates with the Fed?
It goes back to what we said earlier. The Fed controls the destiny of the stock market and of the economy today. They're going to pivot dovish. I think that's inevitable. The question is
when.
Matter of when. The question is, when are they going to pivot dovish, and how much damage is going to be done in the meantime? The good thing is that inflation equation is demand and supply. The more demand destruction we get, the more painful it is in the near term. The quicker inflation, the more quickly, the quicker. I'm not an English major. I don't know which way it goes. The more quickly inflation will decelerate over the next few months, and the more quickly the Fed will pivot dovish. So, Snap's warning last night of demand destruction across the economy. Terrible news today. It hurts. It hurts bad. But the flip side of the coin, the silver lining, is that I think that could be an accelerant to the Fed pivoting dovish, because it'll be an accelerant to inflation decelerating if indeed that demand destruction is happening, which I think at this point it's very clear that it is, given the weakening of the macroeconomic data, given the slowdown in big retail earnings reports, given Snap's warning. I think it's inevitable at this point that the consumer is slowing, spending is slowing, demand destruction is happening. That means inflation is going to come down. That means the Fed's going to pivot dovish. I give it 3 months. If it's longer, stocks are going to stay weaker for longer. Ultimately, the stock market will not bottom and reverse course until the Fed pivots dovish.
Awesome. And then switching into our crypto check-in, any updates? I think Bitcoin's temporarily kind of holding around 30,000.
Yeah. Oh man, Bitcoin, cryptos. It's
Are we seeing continued fallout from the Terra drop, or is this
continued
just
fall from the Terra drop and then not enough wipeout yet. One of my crypto analysts just sent me an article. Adam Newman, the former CEO of WeWork, the disgraced and fallen CEO of WeWork. Do you know that story?
Yeah, yep.
So
But
WeWork.
maybe for some of our other listeners, can you talk about it real quick?
Yeah, so WeWork was this. I mean, it's honestly a fabulous idea of a company of office sharing. Would make a lot of sense in the post-COVID world. This happened before COVID, though, obviously. Fabulous company, fabulous idea. Adam Newman was the head of it, but Adam Newman kind of got overly ambitious, thought too highly of himself or too highly of his business, and just overexpanded, spend to grow, spend to grow, spend to grow. They launched We Live, We Grow. They wanted to do an airline, like a whole bunch of things. And the company ended up basically getting too big for itself. Adam Newman was forced out. They canceled an IPO. The company fired a bunch of people. Was a $47 billion company. Now it's maybe a $3 or $4 billion company. So just a massive fallout. Anyways, the man responsible for all that, Adam Newman, is now in crypto. And he just raised a $70 million round led by the A16Z fund, Andreessen Horowitz, for some blockchain-based carbon trading tools platform or something like that. And it's like, okay, weird. And then I heard about the what's his name, the Martin Shkreli, the disgraced biotech hedge fund guy. He's also in cryptos now and just raised some money in the crypto world. So I don't like that. I don't like that we just had this massive wipeout, and now all of a sudden these people who failed in
Something
the real
else.
economy are now trying to have do-overs in the digital economy, not digital economy, the crypto economy. And it's like, that does not give me confidence in the state of the crypto market today. It makes me, it just makes me feel a little sick about it.
Yeah.
It tells me we need further wipeout, further capitulation, because our thesis.
Yep.
We need a consolidation in the crypto markets wherein the best cryptos survive and the worst get flushed out. Same thing happened with the internet boom and bust back in 2000, 2001. We need that today. The fact that all of these kind of do-over projects are coming into the fold right now tells me we need more flush out. The flush out is not complete.
Now, last week when we talked about Terra, one of the biggest takeaways was that hype doesn't equal quality at all. But why do you think that hype continues to be such an influencer on the crypto market?
Because it's not done flushing out.
Okay.
I mean, so long as hype continues to be a large driver of crypto prices, the crypto market will not have been fully flushed out. Hype will always be part of the equation because there are no earnings, there are no revenues, there are no cash flows. You can't benchmark to any fundamental metric. There's adoption, but not every crypto reports adoption. And those that do report it infrequently. So you can't really benchmark to some fundamental metric. So in the absence of being able to benchmark to some fundamental metric, hype becomes a very real driver of prices. But so long as hype remains the biggest driver of prices, the crypto markets are not done flushing.
Okay.
So I think we need further flush out. I unfortunately think that means Bitcoin goes lower. I unfortunately think that means high quality cryptos continue to go lower as well. But from current levels on a 5, 7, 10-year time horizon, I believe those high quality cryptos will appreciate meaningfully in value, tremendously in value. The trick is, are you holding, let's again, draw a parallel to the .com boom and bust. Are you holding Amazon? Or are you holding pets.com? Are you holding AOL and Yahoo? Or are you holding NVIDIA? There are massive differences in the quality of cryptos out there right now. And it's really tough to discern what's going to be a survivor and thriver and what's going to be a burnout. We think we do a pretty good job of discerning that, but it is a tall order. And so be very careful and very selective in the crypto markets today.
Well, great information and feedback. Switching to our fan questions, rounding out the end of this podcast. Mia T, our girl, happy Wednesday, guys. Luke, can you talk to us about 3D printing technology, companies in the market over the next couple of years?
Oh, I love 3D printing.
I have one already. I have one too. I have a 3D printer. It's a hobby kind of thing, but I love it. You can pretty much make anything.
I did not know you had a 3D printer.
Yep.
Who's the maker of it?
Ender. I have an Ender 3. Yep.
Gotcha. Okay. I love 3D printing. Like vertical farming, this is an emerging technology that is hitting a critical inflection point where I think the need is going to necessitate an acceleration of investment in and deployment of the technology. It's ready for the mainstream. There is going to be, as a result of the current geopolitical situation, a massive recalibration of global supply chains. We used to globalize, outsource, and make things in China and India and Mexico for dirt cheap labor. But the current supply chain crisis is forcing companies to rethink that strategy and recalibrate their supply chains to be more localized. The problem with localizing supply chains is that you innately increased manufacturing costs because labor is a lot more expensive in the US than it is in China. The cost to make something, to build a factory and make something in that factory, is a lot higher in the US than it is in China. So your manufacturing costs immediately go up when you start localizing and recalibrating your supply chains. But this is a cost that a lot of companies want to absorb because they want supply chain security, supply chain reliability. It's much better to be able to make a product, even if you got to make it at a higher cost, than it is to not be able to make a product at all and not sell anything. So supply chain security and reliability are becoming more important than supply chain economics. But companies are only going to absorb so much of that cost increase. So they're going to look for ways to localize supply chains in cost-efficient manners. And the most efficient manner to do so is via additive manufacturing, because additive manufacturing, what it's going to do is it's going to allow you to replace 2, 3, 4, 5, 6 labor positions and have one machine with more productivity, constant uptime, that is just churning out product, material, high quality without error, and doing so at a fraction of the cost that you would be paying labor to do it otherwise. So additive manufacturing is a cost-effective solution for supply chain localization. And if you do get the recalibration of supply chains that I think you're going to get over the next few years, additive manufacturing is going to be a focal point. In fact, the centerpiece of that localization. It's going to be the technology which enables that localization, that recalibration. And so I think that you're going to get a lot of companies buying a lot of 3D printers in 2022, in 2023, in 2024. And I think the companies that make the best 3D printers are going to see huge demand increases, huge revenue increases. That's going to bring economies of scale. That's going to push margins higher. And the result is, what is a hyper growth, money losing 3D printing company in 2022 is going to be a hyper growth, massive money making company by 2025. During that period, those companies, those stocks are going to be huge winners. I think, honestly, 3D printing stocks, certain 3D printing stocks could be the market's biggest winners between now and 2025.
So what inning are we with 3D printing?
Maybe the third.
Okay.
3D printing is really interesting to me because it kind of went through its hype cycle and trial
Yeah.
disillusionment.
Yep.
If you remember back in 2012, like 3D printers were going to like be in everybody's home. They were going to replace 2D printers. That was the thinking.
Yep.
But that was not the real use case for 3D printers. That was a pipeline dream that was completely inaccurate. We don't need 3D. I mean, sorry, Aaron, you got a 3D printer in your home. I hope you have a lot of good time with it.
Yeah. Yep.
But
Nope.
most of us don't need 3D printers in our home. We're not making things. Most of us aren't craftsmen, okay? We're not making things in our home. Who needs 3D printers are these companies, these factories, these manufacturers that are now localizing supply chains. They need 3D printers. The problem with the first kind of go around of the 3D printing hype wave is that those companies, 3D printing makers, made 3D printers for people at home.
Yep.
Demand's not there. So you had that super big hype cycle, and then it's like, oh, trial disillusionment, 3D printers are a fad, they're gone, they're never going to be a thing. Well, now a real use case is emerging for 3D printers. The localization of supply chains. Fortunately, companies over the past 3, 4, 5 years, 3D printing companies kind of saw the writing on the wall for this. So they've rethought their strategies to now make 3D printers not for you and me at home, but industrial grade metal additive manufacturing printers ready to go on the factory floor and make a lot of product. Those printers are going to see huge demand over the next 3 to 5 years. So I think that in that sense, we're in the third or fourth inning in this revolution, where the first inning was this massive hype wave. The second inning was this massive trial of disillusionment. And now we're in this third or fourth inning where we're going to start to enter the secular growth phase, where the third, fourth, fifth, sixth, seventh, eighth, and ninth innings are going to bring about compounded, steady, stable growth in a lot of these companies.
Awesome. Our next question comes from CS Low. Thanks, Aaron and Luke, for the answers. Really appreciate it. On Tuesday, Fed's chair made a few comments, and the market again reacted with a massive sell-off on Wednesday. Is this recurring duel between Fed's tough talk and Wall Street's attempt to push back, intimidate the Fed, going to keep repeating itself? And if so, for how long before we see a stop to this quote-unquote fight? Which side, Fed or Wall Street, should or will likely give in first, and why? Thank you.
Right. No, excellent question. Yeah, and it goes back to what we've been talking about the whole podcast, right? Is that the Fed's tough talk is working.
Yeah.
It's working. It is scaring the living shit out of consumers and companies. I mean, consumers are not spending. Go ask Walmart. Go ask Target. Go ask Abercrombie and Fitch. Down 35% today. The consumer is not spending as much anymore. They're scared. There's a lot of recession talk in the air. And guess what? Enterprises aren't spending either. Companies aren't advertising either, because the consumer is the heartbeat of the economy. They slow, everything else slows. So the Fed has successfully scared everybody.
Okay.
But I don't think they're done scaring people. The Fed wants inflate. Their primary objective right now is inflation deceleration. Get inflation to calm down. They can do that through actually hiking rates, and then also through continuing this tough talk, which creates additional demand destruction. So I think they stay on this tough talk route. I think the Fed continues to talk tough. I think they continue to hike rates, and I think they continue to beat Wall Street in this boxing match.
Okay.
Then eventually the Fed's going to capitulate, go dovish, once inflation has a couple months of deceleration, once the economy is a couple months into decelerating, once stocks have been down for 6 straight months now, but a little bit deeper sell-off, once we're kind of deeper into a bear market with the S&P, then I think the Fed capitulates. Then I think Wall Street wins. Then I think stocks go higher. But the next few months, we said at the top of this call, said in the middle of the call, we'll say it at the end of the call, the next few months could be pretty choppy because the economic slowdown has arrived. The recession may have arrived already. Q1 print GDP, negative. Q2 print, could be negative. It really could be. The way that I'm seeing the data come in, the way that I'm seeing these retail reports come in, the way that I'm hearing companies talk, it's not great. So the slowdown has definitely arrived. I don't think the Fed's going to just stop because the slowdown has arrived. They're not going to stop until they see it in the data that inflation has cooled down. So until that point comes, they're going to keep up the tough talk. And they're going to keep scaring the consumer. They're going to keep scaring the enterprise. They're going to keep destroying demand.
Okay.
And so, yeah, Fed wins. Fed wins, and then Wall Street will win at the end of the day. But for now, the Fed is... And also, it's not really Fed versus Wall Street. I don't want to say like Fed's winning and Wall Street's losing. It's the Fed's doing what they have to do.
Yes. Yeah.
They have to do this. Or else inflation just runs wild, it's out of control, and then we're in stagflation 1970s all over again, which, for what it's worth, we're not going to get a repeat of the 1970s. Let's be abundantly clear on that, okay? We did not have the technology tools at our disposal to fight inflation in the 1970s that we do today. We have vertical farming. We have additive manufacturing. We have automation. We have robotics. We have digital technologies. We have e-commerce. We have all these things, and we have the internet broadly, cloud computing, that we didn't have in the 1970s. So when inflation got crazy in the 1970s, we kind of just had to accept it because we didn't have anything to dramatically improve productivity. But today we do have those tools at our disposal. And that will prevent us from having a 1970s era inflation decade repeating over the next 10 years. So I'm very confident in that claim. But that doesn't mean we don't have inflation today. It doesn't mean the Fed doesn't want to kill inflation. They do. And they have to kill inflation for the good of the economy. They're going to successfully do that. It's going to cause us pain. We're ripping the Band-Aid off. But at the end of this pain, I think it's going to be a short-lived pain. We're going to get tremendous buying opportunities. We're going to get a reversal. We're going to get a big rally. And then I think the next 10, 12 years are going to be pretty good for the markets. We just got to get through this inflation bout today.
That kind of brings us to our last question from Tony Douglas with a similar question from Danny Long. What is your bull case for the markets for the rest of the year?
Exactly what I just said.
Okay.
The bull case for the markets for the rest of the year is, honestly, the best thing that could happen is what Snap just said, everybody else says.
Okay.
Alphabet sees a big slowdown. Amazon sees a big slowdown. Everybody sees a big slowdown. You get this massive demand destruction. It causes earning estimates to go lower. It causes stocks to take a 10 to 15% additional nosedive from where we currently are. This happens very quickly. Inflation decelerates very quickly. By July, the Fed is like, oh, wow. Inflation is really on the decline. The economy is really down. We can go dovish. They pivot dovish. We get the U-turn in markets. The economy starts to come back to life. Inflation is under control because supply chains are normalizing. And then we get that second half massive rally in stocks, which hopefully leads into what will be a durable recovery for the next 5 to 10 years. So that is my bull case for stocks. The best case outcome, as weird as it may seem, is a lot of pain in the near term. Because the more pain we get now, the closer we get to capitulation, the sooner we get to capitulation, and the sooner we get to a Fed pivot, which unleashes a massive bull market for hopefully 5 to 10 years.
So the faster things get worse, the faster things get better.
Yeah. I mean, we have to destroy demand, Aaron. We just have to. Inflation is red hot because supply is low and demand is high. Supply is starting to rebuild. The global supply chain pressure index is showing that supply chain pressures are easing. We're seeing, in some of these manufacturing PMIs come out that production is indeed improving. So supply chains are improving. And the whole localization trend we just talked about is going to be a long-term tailwind for supply chains as well. So the supply side of the equation is starting to shape up. What we need to do now is shape up the demand side of the equation. Demand is too hot. We need to right-size it. And if we successfully right-size it, or the sooner we successfully right-size it, the sooner we can get back to rallying in the stock market. And unfortunately, the way we right size it is through demand destruction. You need demand destruction.
Well, as always, another great discussion. Do you have any last thoughts or words before we wrap?
I think we covered a lot today.
We did cover a lot today. No,
I think we covered a lot of topics.
Yep.
The markets are choppy. They're scary. If you're a long-term investor, I think there's a lot of potential on the horizon. I think you want to buy your favorite long-term, high-quality growth assets and just hunker down. I've said that week after week after week, and I'll say it again today, because these markets are volatile. They're scary. They're going to go up. They're going to go down. They're going to have face-melting rallies. They're going to have gut-wrenching sell-offs. It's going to be ugly. It's going to be, some days you're going to be like, oh my God, this is amazing. Other days you're going to be like, oh my goodness, what is going on? That's going to be the roller coaster we're going to be on. So John Wooden, famous UCLA basketball coach, said, avoid the peaks and valleys. That's true in sports. It's true in stocks. Let's avoid the peaks and valleys. Let's anchor ourselves in things we believe have, in the long term, the stocks are going to go like this, up and to the right.
Yep.
Right now, they're going to go zigzag, yo-yo. They may even go down, whatever. The long term, we are confident is going to be up and to the right. Anchor yourself in those. Survive through this turbulence, and then once we do get that dovish pivot, once we do get that U-turn, which I think we will get within the next 3 to 4 months, that's when these stocks that are high-quality assets will start doing what they do, which is go up and to the right.
Great. Well, thank you everyone for listening. Please, if you have any questions or comments for Luke, leave them in our comments section. We'd love to hear your feedback on any topics you'd like us to cover. And again, see if we can answer any of your burning questions. Until then, please don't forget to like and subscribe, and we will see you all next week. Bye, all.